My guest today, Adam Mesh, is founder of the highly successful Adam Mesh Trading Group, whose mission is based upon discipline, control, and accountability. He's also known for his appearance on the NBC reality show Average Joe, and for his acclaimed books, Full Contact Trading and The Average Joe's Ultimate Beginner's Guide to the Stock Market. Welcome to the show, Adam Joe.
Thanks so much. Thanks for having me here.
I know you're in the New York studio right now. If you were a little bit more south, I could actually call you Adam Joe and probably have it be realistic, but everybody knows your name's really not Adam Joe. But listen, first of all, the Trump bump. Have you seen the same sense of irrational exuberance that I've been seeing right now in the stock market?
I mean, it's hard to explain how we got here. All of last year seemed surreal in how we went up, and then the expectation was going into the election, if Trump became president, that we'd go down, but then we just continued higher, and now it seems that everybody's bullish.
Yeah, it does seem that way. And have your concerns about the market being high, have they grown after the health care bill got shot down in Congress?
It's just hard to buy up here because everything has come so far already. You know, if you were going to go see Hamilton in New York and you didn't buy tickets because they were $250, would you pay $1,000? It's the same thing right now with the market.
Yeah, and you know, it's interesting because when everybody's on one side of a trade and everyone's bullish, you know, you have to be concerned, and that's what we've been seeing. I know I'll blow the whistle on myself. I didn't see the Trump bump being nearly as big as it was. I mean, was this a surprise to you? Or were you telling investors that they can ride some momentum upward, at least between November and now?
As soon as he became president, it became clear that sectors were going wild. And one of the things you saw initially was, and the best example is the financials shot up. They were up around 17% following the election. And now after the first quarter 2017, they're actually down a couple of percentage points. So things have been all over the place, but totally surprised at how strong we remained.
Yeah, and were you surprised at seeing what happened to the 10-year Treasury? You know, the Fed raised interest rates a quarter point, and the 10-year Treasury dropped by almost a quarter point. That doesn't make a lot of sense, does it?
That's what comes with uncertainty. You see irrational behavior. The price of gold doesn't do what it's supposed to do. Currencies don't do what they're supposed to do. It's kind of gives you the statement that nobody really knows how to react, and everybody's caught a little bit off guard. I don't think there's anyone that could say they knew this was going to happen.
So which sectors are you telling investors today have more upside in the stock market? Which are your favorites? I know financials seem to be have gotten a little bit out of favor, as we mentioned. So which sectors right now do you think have the brightest light?
Tech has remained strong. It had a good first quarter that it's finishing up right now. And with innovation and growth, tech seems a nice place to be, not only for stability, but also for upside. And the sector I'd stay away from would be the retail sector.
Yeah, I agree wholeheartedly on the retail sector. It's one of my biggest concerns. So if you're looking at those sectors, how do you recommend investors get involved with those? Just picking blue chip individual securities, or what's your best recommendation there?
That's a great question. And what we've seen this year is more money flowing into ETFs than ever before. And ETFs are a way of diversifying so you're not tied to an individual stock. So let's say you and I both don't like retail and we want to put a bearish play on. We could do it by trading the XRT, but you know, we wouldn't be exposed to Nordstrom's potentially getting bought or takeover talks about Sears. By being diversified, we could be right on retail without the exposure of an individual stock.
So do you recommend that investors go short if they think that something's overvalued?
I like to use options when I'm looking for bearish plays because that's limited downside and you still have some nice ROI. But yeah, I think there's definitely ways to make money when the market goes down.
Now, do you ever recommend that people just get out of the market and sit on the sidelines for a period of time if things are so uncertain? Or do you feel like there's always some sector that has a lot of upside potential?
That's another really good question. I do webinars every week, and I have hundreds of individual investors on those webinars. And anytime I say I don't feel comfortable, we're just going to sit out this week, they applaud the decision and they like that. And I think the investors and the experts like to take a breath and just sit on the sidelines for a little bit and see what's going on. And it's okay to say, I don't know what's going to happen here.
Yeah, it's just humility. I mean, let's face it, none of us knows what's going to happen all the time. If we're right 60% of the time, we're considered to be, you're considered to be a good trader if you're right 60% of the time. So, Adam, if you could stay with us just a bit longer, we need to take a quick commercial break right now. And for Income Generation members watching, stay with us. We have a lot more from Adam Mesh. Welcome back, and thanks again for staying with us, Adam. So hopefully you didn't trademark this, but let me ask you, using your own words, how often, you said that you will tell people to sometimes go to cash and sit in cash when you're unsure about the future in the markets. But the question becomes, how often do you recommend that the average Joe, if you will, makes trades, makes changes in his holdings based upon your strategy, your newsletter?
So I've moved away from day trading, and I encourage others to do the same because you're competing against robots. But if you have that, what I call the little account that could, which is the money that you want to grow to use for vacations, movies, stuff like that, 2 to 3 trades a week with controlled risk, targeting above average ROI is what I feel comfortable with. And it allows for a lifestyle, plus you go after that income every week.
Yeah, it's true. It's when you're trading against the computer, it's kind of like trying to play chess against the computer. It's even the grandmasters can't win. So, if you're saying this is the little account that's designed for vacation or something, then how do you teach investors to determine the amount of money or the percentage of their assets for which this type of trading is appropriate, based upon their age, based upon their goals? I mean, let's talk about that for just a little bit.
So you take an account and you say, okay, this is my risk capital. I'm not going to need it for the rent. I'm not going to need it for any expenses. I'm going to look to trade with this. And ideally you want to have a $25,000 account because that allows for margin. But then what I do is I spend a lot of time going over the exact risk per trade. So if we're talking about options and you're looking at a $1.50 contract, 10 contracts is a $1,500 risk. 1 contract, your worst case scenario is $150. You allocate accordingly. And I like to see no more than 10% of equity per trade, which might sound like a lot, but when you're using controlled risk, it's not.
10% of equity per trade. Now, how about overall? Let's just say that there's an average Joe that has about $500,000 invested. Now, some people may say, well, that doesn't sound like an average Joe, but today there are a lot of average folks that are there or maybe even slightly higher. So let's say that average Joe is 50 years old, has $500,000 invested. How much or what range of amounts would you say makes sense for that person to utilize, with which to utilize your trading strategy?
So you have $500,000. I think if you took an account and you took $450,000 of that and had it tracking the market with a mutual fund that's not going to move more than 3 or 4% each year, you could actually beat that with a $25,000 or $50,000 trading account. Because if you're being more aggressive, again with controlled risk, you're looking at options trades where a couple weeks ago, if you targeted gold, the 117 calls at 98 cents, a day later they're $2. That's over 100% ROI in a couple days on a low risk trade, by the terms of you're only risking 98 cents or $1.
Sure.
So I don't think you need a lot of money, and if you get proof of concept, you could snowball it and start to scale up, as I've seen the best traders do. But I wouldn't be taking $500,000 and trading with it. I don't think you need to. I think it would be irresponsible. I'd rather that be the conservative money, and then that account that you're managing for yourself, it could be smaller, but it could actually outperform dollar-wise the bigger account.
Well, and especially in this market, if you think about it, you and I both are concerned that the market's overvalued. So surely you wouldn't recommend that someone put the other $450,000 in a stock mutual fund right now, correct? Because then they can't even protect that money in the way that you could protect the $50,000 account.
Yeah, I think typically you want to put money away a couple times a year, spread out, so that you're not putting it in timing the market or ill timing the market. And then I also have money in bonds. all different kinds of plans. There's money in a savings account, real estate investments. So there's a lot of different ways to go with that. But yeah, I'm not saying to someone today, take $500,000 and go put it in the market. Definitely not. But I think over time, each year I look to put money in my account and grow it. And it's just, as you know, it's just been an anomaly since 2009. We've just gone straight up. So every time you're putting money in each year, you're typically buying higher. You know, we're looking at 8 years of going straight up. So, I mean, if you don't participate, then you're not making anything. And if you do, you feel like you're chasing. So kind of a double-edged sword, which is why I like having my own account too, that I can manage for myself.
You know, ironically, Adam, I recommend that when I look at this, I would say if somebody wanted to have 20 or 30% in the stock market because they were in their 50s or maybe 60, approaching retirement, getting closer where they want to reduce the risk and buy more bonds and things like that, I'd actually recommend that they put more in your strategy, maybe 20, 25% in your strategy, because right now, the market's being so high, buy and hold, to me, buy and hold is just a sucker bet. At least the things that you are doing give people a chance through sector rotation and defensive strategies. So I love what you're doing. Keep up the great work, Adam, and thank you so much for being on our show today. I very much appreciate it.
Thanks for having me. It was a lot of fun. I appreciate it.